China didn't say a word. It just stopped shipping. In 1 week, rare earth exports vanished, U.S. ports emptied, and Treasury Secretary Scott Bessent was left pleading for a call with Xi Jinping while publicly claiming America is stronger than ever. Meanwhile, the dollar dropped below 99.2 for the first time this year. Bond yields spiked, and foreign investors pulled billions from U.S. debt. And Beijing? No press conference, no demand. Just quiet, calculated pressure. Turning supply chains into weapons? So, who's actually in control? China's export office or America's shrinking leverage? This isn't negotiation. It's a financial demolition. And it's already underway. On May 31st, 2025, the U.S. quietly extended Section 301 tariff exclusions on Chinese imports products like smartphones, medical equipment, and semiconductors until August 31st. What wasn't said out loud is what's unraveling underneath. China has begun restricting rare earth exports again, according to customs reports cited by Reuters, paralyzing 70% of U.S. critical mineral imports. This isn't negotiation, it's leverage. And yet Treasury Secretary Scott Bessent, speaking on Face the Nation, simultaneously accused Beijing of withholding essential supplies while urging Xi Jinping to take a phone call from Trump to smooth things over. According to Reuters, cargo volumes at the Port of Los Angeles, already down 30% year over year, just hit their lowest level since the 2020 lockdown. Bessent's gamble that China will comply with U.S. demands while under direct sanction. But if Beijing's already made its move, what exactly is Washington holding? China currently controls 87% of global refined rare earth output per data from Atomos Intelligence, and nearly 100% of the world's heavy rare earths critical for EVs and defense systems. U.S. firms, from Tesla to Raytheon, depend on a resource flow Beijing can cut off with a single customs code revision. That's precisely what's happening. Imports to the U.S. have declined 19% month over month, with no public ban, just unrenewed licenses. According to the Financial Times, suppliers in Jiangxi have paused exports to unfriendly markets. Bessent is now hinting at consequences, yet simultaneously pressing for high-level dialogue while offering no policy rollback in exchange. The contradiction is striking. You can't threaten a supplier while asking for a discount. And if Trump insists on reshoring semiconductor fabs, what happens when the feedstock is still priced in Beijing? Even as the USTR extended tariff exemptions, Washington moved to expand chip design software bans through the Bureau of Industry and Security, tightening export controls on AI-enabling tools like Synopsys and Cadence for Chinese use. The Wall Street Journal confirmed new secondary sanctions are under review for allies that purchase Huawei 7nm chips. Meanwhile, Senator Rubio publicly pushed for mass visa revocations targeting 300,000 Chinese students. And yet Bessent insists this isn't decoupling. It's de-risking. Beijing isn't convinced. China's Ministry of Commerce told state media it will respond forcefully to what it calls violations of the May truce. At the port of Long Beach, CEO Mario Cordero told WCCB that 0 ships from China arrived last week, the worst traffic levels since early COVID. If this is diplomacy, it's indistinguishable from attrition. But what happens when companies can't afford to wait for policy to catch up to reality? The price of this trade war is no longer hypothetical. Since Trump's 145% retaliatory tariff went live in May, importers have stopped gambling on stable policy. Coffee prices are up 17% in just 3 weeks, according to ICE futures data. As Colombian beans, 30% of U.S. imports now face similar duties. In the broader economy, the U.S. dollar index has fallen 10.2% from its 2024 high of 110 to under 99.2, eroding real returns for foreign holders of U.S. debt. Bloomberg reports that the yen carry trade, a linchpin of global dollar demand, is unwinding as Japan's 10-year yields rose to 1.5%, their highest level since 2012. Bessent continues to reference economic gravity catching up to China, yet overlooks that the U.S. now pays 4.8% interest to borrow for 30 years, up 73 basis points in 60 days. So who's defying gravity, and how long before the debt bill comes due? On May 30th, the U.S. 5-year Treasury auction posted its weakest foreign demand since 2019, with indirect bids falling to 56%, according to Treasury data. Meanwhile, 30-year yields jumped to 4.98%, signaling investors no longer trust the long view. Bessent, in his CBS interview, claimed the U.S. would never default and insisted the debt ceiling will be raised without issue. Yet he conspicuously avoided naming an X date, despite the Bipartisan Policy Center projecting a cash shortfall by mid-August. Moody's downgrade last month cited fiscal irresponsibility and prolonged political dysfunction as key drivers. For bondholders, the risk isn't missed payments. It's value erosion. A 10% drop in the dollar wipes out any yield advantage, especially for foreign investors. The result? Rising yields, falling bond prices, and a shrinking buyer base. If confidence is the currency of debt markets, Washington just ran a deficit. When JP Morgan CEO Jamie Dimon warned on May 31st that the U.S. bond market was one policy error away from a crack, he wasn't forecasting doom. He was flagging a debt trajectory that had already breached $37.1 trillion. Speaking at the Reagan National Economic Forum, Dimon called out unchecked fiscal stimulus and post-COVID quantitative easing as key contributors to a fragile Treasury ecosystem now buckling under a $2.5 trillion deficit expansion. But Treasury Secretary Scott Bessent, instead of rebutting with data, dismissed Dimon entirely. None of his predictions have come true. It was a line aimed at undermining credibility, not logic. Meanwhile, Bloomberg reports that foreign holdings of U.S. Treasuries dropped to $7.4 trillion in April, down $110 billion in 60 days. That isn't opinion, it's flight. So if Dimon's track record is flawed, what does that make Bessent's current performance? But the tension didn't end there. Bessent doubled down, insisting the deficit will gradually decline over 4 years, despite CBO data showing the 2025 fiscal year already surpassing $1.2 trillion in cumulative shortfall as of April, compared to $860 billion at the same point last year. And with the big, beautiful bill still pending, Senate approval analysts at Moody's expect the debt ceiling to rise another $4 trillion by year end. Dimon wasn't just speculating, he was diagnosing. Bessent responded not with a treatment plan, but with salesmanship, which raises a question. If Wall Street is warning a fracture and Washington is selling reassurance, who's really looking ahead? Back in January, Bessent and Trump promised 90 deals in 90 days. 5 months later, only a single deal with the UK exists, and even that hasn't moved shipping volumes. According to the Port of Los Angeles, cargo traffic from China dropped to 0 departures on May 10th, a collapse not seen since the COVID bottlenecks of 2020. Retailers in San Pedro Bay are reporting shortages in electronics and raw materials, while procurement contracts from Shanghai are stalled indefinitely due to tariff risk. Axios confirmed Beijing has paused all tech shipments not under long-term contract, citing policy uncertainty and counterparty instability. Yet even as supply chains fracture, U.S. trade officials continue to frame the slowdown as temporary. But the numbers contradict that. Walmart raised import-adjusted prices by 3.4% in May alone, including logistical volatility from the Asia-Pacific corridor. And the Institute for Supply Management reported a 6-point decline in new orders for U.S. manufacturing, the steepest drop since 2022. This isn't just a diplomatic hiccup. It's a real-time economic drag. And if no new agreements arrive before Q3, the contraction won't stay offshore. It'll hit store shelves. Bessent claimed China will absorb 65% of the tariffs, a projection loosely echoed from a 2019 NBER study, but the latest numbers don't support it. According to U.S. Customs and Border Protection, total tariff revenue hit $177 billion since 2018. Yet U.S. consumer prices on affected goods rose an average of 11.3% per the Peterson Institute. In May 2025, alone prices on Chinese-sourced electronics increased 4.8%, with importers passing costs through Walmart, Best Buy, and even Dollar General. Bessent argues that Chinese exporters are subsidizing the difference, but real-world behavior tells a different story. Chinese shipments to the U.S. are declining, not increasing. And firms like BYD and KTL are shifting production toward Africa and Latin America to bypass U.S. levies. Meanwhile, U.S. importers are hedging with shorter contracts, even at a 20-30% premium, due to fears that Trump's next tariff announcement will hit mid-transit. According to the American Apparel and Footwear Association, this has driven up landed costs by 18% in Q2 2025 alone. If China were really eating the tariffs, their goods would be surging in volume to maintain margin. They're not. Who's paying you already are. And inflation data from the Bureau of Labor Statistics is finally catching up to that reality. In his May interview, Besant insisted the U.S. will never default. And technically, he's right. But default isn't the only way bondholders lose. Inflation, currency depreciation, and maturity mismatch quietly destroy returns without a single missed coupon. Treasury's latest bond auction confirms the shift. 30-year yields climbed to 4.98%, while 5-year notes remain stable near 4.23%. A yield curve that signals long-term distrust. According to the Federal Reserve, foreign demand for long-duration debt fell 14% quarter over quarter, with Japan and China reducing their combined holdings by $48.7 billion. Meanwhile, Moody's May downgrade of U.S. credit conditions cited unprecedented policy instability as a key driver reflecting market anxiety, not just math. And Besant's refusal to name an ex-date for the debt ceiling wasn't strategic ambiguity. It was fear. Naming a deadline risks triggering a run. But bondholders aren't waiting. They're reallocating. Because while the U.S. might never default on paper, the value of that paper is already deflating quietly, persistently, irreversibly, unless something changes. So now that you've seen the full picture, China's export blockades, collapsing cargo traffic, rising borrowing costs, and a Treasury Secretary stuck between deflection and denial. Ask yourself, who's really in control? Scott Besant is betting that optimism will buy time. But Wall Street is already shortening maturities. Beijing is already moving markets with quiet refusals, not press releases. And U.S. consumers, they're already paying the bill. So what happens if the debt ceiling gets lifted, but trust doesn't? Drop your thoughts in the comments. Is this just another cycle or the start of a systemic correction? Because if trust collapses after the ceiling is raised, then America hasn't solved the crisis. It's just postponed the reckoning. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.